Buying expensive premium-priced properties is a sure way to have all your eggs in one basket. To top it off, losing serious cash flow in the hope to have capital growth is not how it has to be. Join Terry Ryder from Hotspotting and Arjun Paliwal from InvestorKit on an exclusive smart property investment webcast as they share more on how you don't have to buy expensive to buy good. Register now at smartpropertyinvestment.com.au.
Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Hey everyone, how's it going? Welcome back. Good to be with you. Alex Whitlock hosting this particular show. I thought we might take a bit of a different angle around property investment. We talk in great detail about how to construct a portfolio. We look in great detail at times at particular suburbs and where we think there's going to be growth. We also look at sort of the market conditions and the things that are fueling opportunity for the future. But one of the fundamentals that I thought would be good to focus on, and from a personal perspective, is really how to go about building a portfolio, not from necessarily putting assets in there, but really from a planning and from a perspective point of view. Building something long-term for the future takes a lot of strategy. And I think so many of us, myself included, end up making a purchase and then sort of cobbling things together as we go along. So I'm really pleased to invite a guest. This is a chap who has his own podcast. He focuses specifically on helping millennials in the planning process. These are, young people coming into just that point in their lives where they're starting to build some wealth. It's John Pidgeon, and he has a podcast called My Millennium Wealth. John, welcome to the show.
Thank you, Alex. My Millennial Money, sorry.
My Millennial Money. I do apologise. John, I just thought, I don't know about yourself as a property investor and a property buyer, but my first purchase I made in 1998, I bought off the plan. I was living in Hong Kong at the time. I'd started to earn proper money for the first time myself. I'd started to maybe grow up a little bit and realise that rather than spending all the cash that I'd got, I had an opportunity to start putting some money away. And at that point in my life, I knew I needed to do something. I didn't know if I was saving to buy some shares. I just started to see some money building up. Now, I ended up buying an off-the-plan apartment in the South Bank. I bought a 2-bedroom, new build, $217,000. Very cheap in today's money.
Absolutely.
And you know what? It was a good purchase and I made money on it, but it was a bit of a knee-jerk reaction. I didn't really quite know where I was going. And I've now got a portfolio. I've got a shared portfolio with my business partner, Phil, which is about $7.4 million worth of property. I've got my own personal portfolio as well, which sits around probably about a couple of million at the moment. But just going back to those early days, why is it that people like myself tend to kind of jump in and maybe, in the absence of a strategy?
Yeah, it's a really good conversation. And we do have a lot of this around the millennials because they're at that first time like you were. And I was the same. I was 1999, I think.
Okay.
$60,000 purchase in country Victoria where I was living. And it was an investment purchase. But yeah. Again, didn't really know what I was doing, just had a deposit and here we go and rent it out. And yeah, it doubled in, I think, 2 or 3 years. So I thought things were pretty easy.
So what made you decide, at that point back in 1999, what made you decide to make that investment?
Yeah, I think it was always a goal of mine to invest in property because I like reading up on it. I understood it. It was easier for me to drive past it and get it versus shares that my brain wasn't wired that way. And I think I meet a lot of people that are either one or the other. And through what we do, it's obviously working more towards property, but not always. I think just understanding that you might be a combination of both, but either way, you've got to educate yourself in what you're going to invest in and not just fly by the seat.
I think the interesting thing for you and me, and I think for many people out there, you get this kind of, I suppose, a calling one way or another. It's time for me to do something. And you get that kind of like surge of motivation.
Yeah.
But you just kind of, because I was sort of late 20s when I bought, you just don't know what you know when I'm 52 now. And so you kind of get this desire to get started, but you lack the vision of knowing what the end goal is. So how do you help educate people on how to sort of look that far forward, 20, 30, 40 years forward?
Yeah, it's a really good question. And I think the great thing about the millennials that we deal with, more importantly, they're actually putting their hand up to say, look, you've been there and done that. Show me the pitfalls and show me the path that I need to take to avoid all those pitfalls. Because traditionally, I think people go and get a borrowing capacity. They've got some savings or a donation from mum or dad, and they've got a borrowing capacity, and they use that as a guide to say, well, the bank will lend me $400,000, so I'll just go and look for property that's $400,000. Could be anywhere. They come across a glossy brochure like an apartment in South Bank or something like that, and all of a sudden, a week later, they've purchased it.
For me, it was, I worked in Hong Kong, worked in media the same as I do now, and I used to sell advertising to a developer. It's called Central Equity.
Right.
And the guys who I used to sell advertising to, they used to make me come down to their office every month. They wouldn't book a year's contract. So I had to, and they used to write an article, and it would be on negative gearing or on, understanding leveraging or, sort of capital gains versus cash flow. So I'd have to read these articles, and I ended up walking into their office one day and looked at one of the big fancy model they got there, and I got this money that I'd saved. And you know what? I made a good investment, but I on a spur of the moment said, how much is this apartment? And that's what took me in there.
I'll take it. Yeah.
So it was a very unplanned investment, and I was very nervous about it, but also very excited. But it was and what I didn't know, and this is one of the things about planning, I made a good decision to go into property, but I made an ill-informed decision because I didn't understand the costs around body corp. I knew how much I was paying for the apartment, and you made a purchase in a rural area, but for me, I bought an apartment in a high demand area in Melbourne. I knew I was going to get a certain amount of rental, but what I didn't know as an inexperienced investor is exactly how much of that rental value I was going to lose to management fees, to maintenance of the property, the swimming pools and lifts and tennis courts and all those sort of things. So
supply and demand.
Yeah, that's right. So
So I'd probably go back or delve a bit deeper with that and say, well, the first criteria is you've got to put your hand up and be open to learning and understanding and listening instead of going in thinking, I know it all, I'll be fine sort of thing. The second part to that is knowing what you want short-term and long-term in your life. Now, no one knows what they want in 20 years' time, or very rarely.
It's hard to focus that far ahead,
But we just throw some things out there that might relate to their hobbies or their interests or their wealth creation and their work and their vocation. So once I think you've got that long-term vision, you can start to look a little bit more with certainty on your short-term 1 to 3 year plan.
Okay.
And as you know, Alex, property is not a 1 to 3 year plan. It's a long-term journey and often a boring one.
It's quite interesting because going back to my purchase, because this particular developer was in the business of selling apartments, that's what they did.
Yeah.
And they would have a new development and they would sell those. So the rhetoric around their apartments was, take a 1 to 3 year view. It was not about coaching and mentoring and educating people who bought. Their job was to sell property.
Yeah.
And so that kind of, in some ways, because I didn't educate myself from a sort of a 360 degree perspective, I was sort of thinking, 1 to 3 years and then, I'm going to move it on. It was not really a long-term, so I think, as you say, helping people to understand that it's not a 1 to 3 year, sort of approach, that it is a long-term view and understanding why I'm buying this asset and what I'm going to do with it and how potentially I'm going to leverage off it. And then, sort of understanding, am I going to have one property and then go and invest in some other things? Do I want to build a portfolio?
Yeah, that's it. Absolutely. And I always say to the listeners and the clients is to make sure that you're thinking about your next investment before you purchase the first one. So if you've got that in mind, you're looking past that and you can make a more of an informed decision around, well, do I spend 400? Do I spend 600? What yield does it need? What location are we likely to look into? What entity will it be in? So digging a lot deeper in relation to strategy, but long before that, understanding your cash flow management in your life. And
that's a really good point, because it can become a burden when you're committing yourself to buying a property and, and knowing how to keep the balance so you're enjoying your life and not feeling like a slave to your mortgage.
Absolutely. And I think if not a lot of Australians, in my experience, know what's going out of their bank on a monthly basis. So if we can understand that simple formula of how much it costs us to exist on a month or a 2 month or a 3 month journey, gives us a lot of confidence to go forward with, to understand what yield we need in our property portfolio as well.
I'd like to have a chat actually about budgeting. I think it's a pretty critical thing, and we'll get onto that in just a couple of seconds.
Do you want to capitalise on the projected growth opportunities in Brisbane? Streamline Property Buyers are your local area experts with a qualified property investment advisor, licensed builder and rent specialist, making them the most qualified buyers agents in Brisbane. This team know Brisbane property better than anyone else. Find out more at streamlineproperty.com.au.
So, John, we were talking about, you touched on a very, very important issue around cash flow management and budgeting. And really, before you can get into, for most of us to get into property investment, you've got to start accumulate some funds that you can put towards a deposit. So what are some of the fundamentals that people who are maybe not yet in the market should be looking at in terms of their budget? Or, hey, you know what, you might actually have a property and you might be struggling. What are some of the fundamentals around budgeting?
Yeah, and I'm always a big believer that people make the mistakes, not the property. And how that occurs is because of their lack of preparation to begin with. So understanding your cash flow, number one. So what goes out of your life from a personal level, as I said, on a monthly or 2 monthly basis. And then having an understanding of what you're saving per month. Right. Rule number one is you need to be saving and not spending more than you earn.
Yes, absolutely.
It's quite logical.
And there's a really funny thing as well. I think that's a great point, because I think people do, when they step into property investment, they have this really bizarre view that suddenly all their spending habits are going to fade away.
Yeah.
And they're going to suddenly live on this more frugal life. And I think that, to actually start up to behave like that beforehand is far more realistic, because if you can't do it in the run up to purchasing a property, you're not suddenly going to magically stop going out, to the cinema and going out for drinks and dinner.
Yeah, and I make a clear distinction that personal is personal and business is business. Now, to me, property investing or share investing or anything that's investing in an income producing asset is considered business, very separate from your personal life. So you should have a property buffer in your life, or a share buffer, whatever that may be. But more importantly, you need a lifestyle buffer to know that in the event of something unforeseen, the car breaks down or need to go to hospital or whatever, I've got 2 months or 3 months worth of expenditure sitting in a bank account there exclusive for my personal life. I don't meet many Australians that come to us saying, yeah, we've got our emergency buffer already sorted, let's go and buy property.
I think that's a really, really fundamental point for people to focus on. Buying an investment property needs to be separated from everything else that you do in life. And I think treating, and from the outset, and this is something I've understood now, over many, many years of investing, it is a business and it has its own cash balance. There's, there's income coming in, there's outgoings going out. You will also typically have a team of people who you employ to work on that particular, even if it's one property, you'll employ an accountant. You will probably have a relationship with a mortgage broker or certainly a bank. They work for you. So you end up running a team in many ways, and you'll have a property manager that looks after the property. So having that mindset that this is a business, and in terms of in Australia, there isn't, we still have negative gearing. So there is a tax benefit if you lose money in that particular business. So I think that's a really, really good point from the outset.
Yeah. So once you've got that understanding of your personal cash flow management, then you can take the next step of, well, what do I want in my life, goal setting, short and long term. But then also looking at I get our clients to write down the top 3 fears in our life or going to invest. What are those top 3? And let's understand them, and let's look at that.
What do people typically say? I'd be interested to know.
Yeah, look, they're wide and varied, that's for sure. But I think the most common one is rental vacancy.
Yeah.
What if no one's paying me rent on a weekly basis? Right. So I think with research we can easily overcome that, but more importantly, forecast for some element of rent vacancy throughout the year.
Because the reality is, you just get vacancies when, when a tenant comes to the end of their lease just to get the right tenant in. Usually there's going to be a shortfall. I think a lot of investors think that A, it's going to be tenanted forever. Yeah. B, the rent will continue to go up, which, over the long term it does, but it's, you may go up for a couple of years and it dips down again. And I think, the third thing is that, that there's never any vacancy rates in there, that there is that natural time where, there are not tenants in the property.
Yeah, there has to be. And obviously a lot of research goes into the location to ensure that that vacancy is kept at a minimum with the supply and demand in check as well. But I think we look at the vacancy, but we also look at the worst case of, well, what if I lose my job? That's another fear. Now, I've got a different view on this as opposed to a lot. What's riskier, losing your job when you own your own home that you live in, or owning an investment property and losing your job?
Absolutely, owning your own home.
Owning your own home.
Yeah.
So you're the one that's responsible for that mortgage. Whereas an investment property, if I lose my job, the tenant's covering a lot of, if not all of, the running costs of that property. So I think when we analyse what the fears are for someone, but then more importantly overcome them or just be aware of them and factor them in, it makes our property investing a lot more smooth.
Fear is a really, really fascinating point in investing, because it can make your attitude towards fear can make you a good investor or a bad investor for different reasons. If you're overly fearful, it can make you perhaps more conservative than you need to be if you don't actually understand what it is you're fearful of, and can just sort of diminish your appetite to invest. If you have no fear and you are reckless, then you can end up, with over leveraged, with unrealistic expectations, and you see people who lose their whole portfolio. And I think it's a really critical thing. And I think an interesting thing around fear and investment is, and certainly speaking personally, I got very excited about buying my first property, and I then took on what now seems like a very small loan, but at the time was a big loan. And you've got this kind of sort of sense of like, I have this debt. In some ways, that element of fear can be an obstacle to moving to buying a second property, because you can go, well, in my case, I owed $180,000 on that first, apartment. Yeah. I'd saved up some money to buy a second one, but in my mind, I was saying, okay, this is going to now take me to, close to $250,000. And that back in, the late 90s was an awful lot of money.
It's all relative, yeah.
But so fear is, I think, to your point, understanding what fear is with relation to property, and understanding the difference between good debt and bad debt, and, your general fear of, sort of vacancy rates and so forth, and getting some sort of perspective on that is really critical.
Yeah, absolutely. And another foundation to that is our wills and estate and insurance. Right now, a lot of people look at that and say, well, yeah, I don't want someone banging down my door trying to sell me insurance. But the real facts are, well, we go and insure our car, we go and insure our home for fire and whatever else. But do we insure our biggest asset, which is ourself? Now, to me, that's a no-brainer. Yeah. Especially if you're increasing your assets and have other dependents in your life, the chances of you getting sick or injured is much more likely than crashing your car or your house burning down.
Look, insurance is, I think it's a real fundamental that's often not sort of talked about in property. And look, let's dig into this in a little bit more detail in a couple of seconds.
Worried about making the wrong choice with your next investment? You're not alone. If you truly want to become the master of your own lifestyle design through real estate, then you need to speak with Buyers Agents, who'll help you acquire cash flow positive properties in high growth areas with value add potential, so you can create more freedom in your life. Visit dashdot.com.au/SPI.
So, John, we were just talking a few moments ago about the importance of insurance. And before we sort of get into the various different types, I'll just tell you that I've got a couple of properties up in Queensland, Deception Bay, and I've had them now for just over a year. In that particular area, it's quite a challenging area to find the right tenants. Yeah. And I have, just on the topic of insurance, so I had a tenant that stopped paying rent for one reason or another. I don't know why. As they went into arrears, then obviously their attitude towards the property declined. Eventually, they were evicted, which was quite a painful process, because as a landlord, I felt bad, even though they weren't paying my rent. But the property manager advised that this is the course that we needed to take. So I ended up with not only, a bad experience with that property, I also ended up not only with a gap in my rental, but I ended up with some fairly significant damage to the property, because by the time they were being evicted, they really genuinely didn't care. There's no maintenance going on. Not saying there's necessarily willful damage. Now, I've always had for my properties landlord's insurance, and although it hit me in terms of having to meet those financial commitments to my mortgage lender, I'm now in a position where I'm going to be able to gain back some of those expenses from my insurer. So, it's really, really, and it does happen, and it's really easy to think that insurance is an expense, be it landlord's insurance or personal insurance. It's easy to think it's an expense you don't need.
Yeah. Look, and I think it's a fundamental, as I said, one of the foundations that we look to with clients. But the only exception to that may be if you're single and haven't got any assets, like it's just you that you're responsible for, and that's all. But in majority of cases, you just want to have a check on that, and definitely not be overinsured by any means. But
no, absolutely,
just have the appropriate for you, and have as I said before, an expert in your team that can cover off on that for you.
But it comes back again to sort of the point you raised earlier about just having a balanced approach, because it mitigates, if you have the right insurance, it just mitigates risk. Yeah. If you've got a good measure of your cash flow, then you've got confidence around managing your investment, plus also managing your personal expenses and keeping those things separate. So and I think it also helps having the right structure to your investment strategy, gives you confidence then in a measured way to look at growing and sort of building your portfolio.
Yeah, 100%. So all this is probably, listeners are thinking, well, this is all boring stuff. Let's just get to the property stuff. But I think it's so important, because if you look back on where it went wrong for someone, more often than not, it's because of that planning that wasn't there that created the snowball effect.
I think also in terms of planning, and I think for me personally, a really interesting thing around property, and I think that property is a very forgiving investment. Now, that doesn't mean that if you make an absolutely catastrophic investment decision, that won't end up being, bad for the long term. But you know what? You can make, in terms of planning and understanding, you can make a mediocre investment right now, today. Now, if I try and make money off a mediocre investment over 1 to 3 years, I'm probably going to fail unless the market just so happens to take all the boats up, in a rising tide.
Yeah.
But one of the things from my experience is if I make a mediocre property investment decision and I hang on to that property for 20 years, 30 years, 40 years, that property is going to be worth significantly more. So I guess the point I'm making here is it's not only about the asset that you're investing in, it's about understanding long-term goals. I'm not suggesting that, I think if you do things right as an investor, if you do your due diligence, if you understand where you're going and why you're buying and what you're buying, if you know whether you're looking to build long-term asset that's going to generate cash flow and also appreciation, rather than thinking that you're going to buy something and flip it in 12 months' time, I think knowing where you're going and having a plan is really critical. And I think that property done the right way with the right plan is quite forgiving. I don't know what your thoughts are.
Yeah, 100%. No, you're right. And that's, as I said, that long-term goal forecasting is so important, and your expectations on the way in are critical in that. And look, flipping properties is definitely a strategy and a common strategy.
Yeah.
However, if you've got a base of properties in your portfolio already and you go and flip a property, then you're not relying on that one asset to perform for you. Whereas first-time investors, if they go and use that strategy, it's all the eggs in that one flip strategy, which obviously increases the risk. But understanding that, it's a long-term process, but the common one we get is, do I buy my first home as an investment, or do I buy my first home to live in because I've got this first homeowners grant available to me? And I had this question yesterday with someone where what they were saving from a stamp duty perspective was about $12,000, right? But if they're buying in an area where it was flat or readjusting, going on a slightly downward spiral, then as opposed to buying in a growth region or a potential growth region, you can make up that 10 or 12 grand pretty quickly.
Absolutely, yeah.
Yeah, it again comes back to what they want to achieve long term that helps them make that decision.
I managed to avoid buying my own home for a good 10 years, and then the pressure with growing children became too great, and I succumbed. I had to sell off. I had to sell off a lot of my initial investments. And you know what? I got a. I hung on to two investments, two apartments that was in the South Bank. So I still had something to leverage off. And I'm glad that, I'm glad I bought my own home, but I'm also glad I had the foresight to hold on to those two investments, because they were a launch pad for me to leverage off when I sort of started to reinvigorate my portfolio. And look, we'll talk another time with Phil, but we built our portfolio off a very, very low base. We bought very carefully, and we were chatting just the other day, we look at all the houses that we turned down at auction, back in 2010, 2011, that were going for a couple of $100,000, in certain suburbs in Sydney. You go, I wish we'd bought more. But you know what? Yeah. We were, at the time, you don't have a crystal ball and you don't know where the market's going to go. So we had a walk away price, and,
you stuck to it.
Yeah, absolutely. Yeah. Look, I know that you're not investing at the moment, but you working on a project with your own home. What's happening for you in terms of property at the moment?
Yeah, so I went down the similar path of rent vesting. I was told at an early age, rent until you can buy your own home to live in with a very minimal mortgage. So that stuck true with me for a number of years. So I also succumbed to the pressure of family and kids and wanting to own home. So I think it was 15 years before I decided to do that. So in the last 3 or 4 years, we've done that. So at the moment, we're in the process of renovating that and doing that up at the moment. So that's our 15 to 20-year home. So there's no reason as to why I want to move from there. So
how you going with the rent? Are you doing it yourself? You got tradesmen in?
These hands aren't too handy. Yeah. But thankfully, a lot of friends and that are pretty handy close by that is working on that project for me. But definitely take a solid interest in I suppose, project managing and understanding the process and definitely the numbers of forecasting as well. So we've got a 3-year plan to basically get that completed.
Good stuff. John, it's been great having you on the show. Look, thanks so much for giving up your time.
No worries.
For everyone else, thanks so much for tuning in. It's great having you here. If you've got any stories you'd like to share with us, we would love to hear from you. It doesn't matter if you're gearing up for your first purchase, if you've got a substantial portfolio, or if maybe you've just made your first step in the investment market. Get in touch, let us know. Contact us at editor@smartpropertyinvestment.com.au. You can reach us on all the usual social media. We're on Facebook, we're on Twitter, and don't forget to check out all the latest stories on smartpropertyinvestment.com.au. Thanks for tuning in.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
If you're a regular listener to the Smart Property Investment Show, then odds are you're already a property fanatic who loves hearing stories on investing from real people. The good, the bad, and the ugly. Be with people just like you and join the group Passionate Property Investors on Facebook now. Become part of a community who know what to do and when to do it. And the time to do it is now. Passionate Property Investors. Tribe, tools, and tips. Find us on Facebook today.